Hey everyone, and welcome. Today, we're going to tackle a topic that honestly affects pretty much anyone who invests, owns property, or even has some valuable collectibles. Yep, we're talking about capital gains. And stick with me because by the end of this, you'll know exactly what you're dealing with. Let's dive in. So, let me ask you this. Have you ever sold some shares that, did really well? Maybe you flipped a property, or hey, even sold an old piece of jewelry for way more than you originally paid for it. If you're nodding your head yes to any of that, then guess what? That profit you pocketed might just be subject to something called capital gains tax. Now, don't worry. It sounds more complicated than it is. Understanding it is the first step, and that's exactly what we're here to do. Okay, so first things first, what even is a capital gain? Let's get right to the heart of it. You can really just think of it like this. It's the gain you make on your capital. I mean, it's right there in the name. You buy something for one price, and then you sell it for a higher price. That difference, the profit, that's your capital gain. See? Simple as that. Okay, that obviously leads to the next big question, right? What exactly counts as a capital asset? And this is super important because getting this right determines what you have to pay tax on and what you don't. And trust me, the definition is probably a lot broader than you'd think. So, of course, it includes the things you'd expect, like land, buildings, shares, and securities. But it also covers things like jewelry, certain gold bonds, and yep, even some digital assets. Basically, you should think of it as covering most valuable property or investments you can own. Now, here's where it gets really interesting, and it's a super important distinction. Most of your personal stuff, your clothes, your furniture, that's usually exempt. But the law makes a specific exception for jewelry. It's explicitly carved out. So those ornaments made of gold, silver, platinum, that family heirloom you've got tucked away, yep, that's considered a capital asset. So just owning one of these assets doesn't mean you owe any tax. Nope, the tax only gets triggered when a very specific event happens. Let's take a look at what that is. The key word here is transfer. And you really need to be careful with this one because transfer doesn't just mean a simple cash sale. It could be an exchange, like trading one asset for another, or even just formally giving up your rights to it. The second that transfer happens, boom, you've potentially created a tax liability. Okay, but what if it was a gift? This is a question that comes up all the time. I mean, if you're not selling it, you're just giving it away. That can't be a taxable transfer, can it? And you know what? You'd be right. The law is very clear that some transfers are not taxable. For most of us, the big ones are gifts or anything passed down in a will. There are also a bunch of exemptions for corporations, like during a merger, so the takeaway here is really important. Not every single transfer is going to land you with a tax bill. All right, let's say you've made a taxable transfer. Now comes the big question. How do you actually calculate the gain or loss? Well, the basic math is actually pretty straightforward. Let's walk through it together step by step. First, you start with the full sale price. This is pretty much what it sounds like. It's the total amount of money you got when you sold the asset. Okay, from that number, you're going to subtract what it originally cost you to get the asset in the first place. This is what's known as the cost of acquisition. And it's not just the purchase price. It also includes other expenses, maybe like brokerage fees or any money you spent improving the asset. And there you have it. The difference between those two is your capital gain. Now, that simple formula works great for the basics, but for assets you've held for a long time, there's a really important adjustment that comes into play. This is a concept called indexation, and honestly, for long-term assets, it's a total game changer. What it does is it lets you adjust your original cost for inflation, so you get to increase your cost, which in turn lowers your taxable profit. You're basically only being taxed on the real growth, not just the part that was due to inflation. This is one of the biggest reasons why the difference between holding an asset long-term versus short-term is so huge. Long-term gains get this amazing benefit and are often taxed at a lower rate too. All right, now for my favorite part. Once you've figured out your gain, it doesn't automatically mean you have to write a huge check. There are actually ways you can legally reduce or sometimes even completely eliminate the tax you owe. One of the most powerful tools in your toolbox is reinvestment. For example, let's say you sell a property and make a nice profit. The law often lets you avoid paying tax on that gain if you reinvest it into another property within a certain amount of time. And it's not just for houses. Similar exemptions pop up for reinvesting in specific types of bonds and other assets. But what happens when things go the other way? When you have a loss? Well, the tax rules have you covered there too. If you have a capital loss, you can use it to cancel out your capital gains for that year. And get this, if you have more losses than gains, you can carry those leftover losses forward for up to 8 years to offset future gains. This is such a critical tool for any long-term investor. Okay, so let's pull all of this together into a quick, simple checklist. Whenever you sell something, just run through these 5 points. 1. Was it a capital asset? 2. Was it a taxable transfer? 3. Did I calculate the gain correctly, remembering to use indexation if it's long-term? 4. Can I reinvest the money to claim an exemption? And 5. Do I have any losses from previous years that I can use to offset this gain?
See, understanding capital gains isn't just about compliance or paying taxes. It's really about making smarter, more informed decisions with your money and your investments. It's about knowing the rules of the game so you can plan for growth more effectively. So now that you have these basics down, what's your next move going to be?